Hey, welcome back to Innovate Africa. You know by now that we focus on innovative businesses that impact lives on the African continent. But if you're an innovative business that does that, you've got a bit of traction, you want to grow, where do you find the capital from? Where do you get hold of those networks? You need to have networks, you need to have access to market. And it's not easy. You can't do these things on your own. But people go to VCs. Is that the right thing to do? Should you get debt financing? What should you do? And there's one person who's been around the block. He arrived in Africa in 2010 for the World Cup and decided to stay. He's the co-founder of Launch Africa VC. His name is Zach George, of course, the most prolific pre-Series A VC on the African continent. Zach, what a pleasure having you on Innovate Africa today. I think, first of all, Launch Africa, where it started, how it launched. Just give us the story.
Of course. Thank you, Kino. I appreciate it. Launch Africa started about 5 years ago on the back of me coming to South Africa, as you mentioned, 15 years ago in 2010 for the World Cup. I used to be an investment banker in Wall Street for many years, got my MBA from Stanford, and I had the opportunity to see the best of Silicon Valley and the best of Wall Street. And I found that if you could mimic those ecosystems in emerging markets like Sub-Saharan Africa, Southeast Asia, Latin America, India, you could do so much more of a service to entrepreneurs than just aid, philanthropy, or heavy investments into natural resources, mining, agriculture, etc. So I came here in 2010, built the first corporate-backed venture accelerator called TechLab Africa, which we sold to Barclays, then ran Startup Bootcamp, one of the biggest accelerators in the world. I ran their Africa operations together with my co-founder, Philip. And eventually, we saw this massive gap between angel investment funding, which is pre-seed accelerator sort of funding your minimal viable product, pre-revenue, where there's a decent amount of understanding. And then there's a lot of funding at Series A and Series B, which is when you're typically doing at least $1 million in annual revenue. And there are later stage VC funds, private equity funds, even corporates that will back you. But in that sort of missing middle, that valley of death, as people often allude to, when you're doing anywhere from $5,000 to $10,000 in monthly revenue to about $50,000 to $100,000 in monthly revenue, that's that gray area where you have a product, you have some initial customers, but you don't have capital to scale. You're a little bit too risky for later stage VCs, and you're way too mature for people that take very early bets, right? That funding in Africa historically for the last 10 to 15 years has primarily been filled by angels. So it's drip funding. You get $10,000, $20,000, $30,000 checks from a bunch of individuals, maybe a couple of family offices, but it's inefficient capital. So Launch Africa was born out of a need to provide institutional gravitas to early stage funding. So it's bringing mature capital that not just brings money, but has, as you mentioned earlier, networks, resources, connections to telcos, banks, insurance companies, retailers, helping you with cross-border expansion, teaching you about IP protection, legal, tech requirements. So capital by itself is almost meaningless if it doesn't come with strategic value add. And that was why we created Launch Africa Ventures. My partner, Janade, who used to be the head of venture capital at a big South African bank and the chief investment officer of the African Development Bank for many years, we joined forces in 2019, and we set up, we had a modest target of setting up a $10 to $15 million fund to invest in 40 to 50 technology startups across Africa. And in the midst of COVID, we overshot even our wildest expectations. We raised $36 million from more than 200 investors across the world. And we invested that capital into 133 startups in our first fund. And that fund is right now tracking more than a 22% IRR. So we're very proud of what we've done. We're building our second fund now. But I'm, again, very happy to share some of our wisdom and insights into how venture can change the African continent.
So a lot of people watching now might be thinking about VC funding, they might consider it for the future, but the big question is, how does a founder or a founding group and a business know that they are VC ready? And because a lot of people just go to a million VCs and ask a million questions when they should be doing their research. So tell me a bit about that.
Yeah, I mean, first of all, I mean, this this is not to burst everyone's bubble here, but venture funding is not for everyone. It's in fact probably only for or relevant for less than 0.1% of founders. Venture capital defies every idiom, axiom, theorem you can think of in traditional business school think. Traditional business school mindsets or corporate mindsets are build a business that's fundamentally profitable or has a path to profitability, creates wealth for the owners, and has a long-term sustainable value creation to the community around you. That is what SME financing is about. The vast majority of businesses, not just in South Africa, Nigeria, Kenya, but the whole world, are SMEs. Even the great is a belief country of the USA. The majority of their GDP comes from SMB, small businesses. Those businesses should never seek venture capital funding. Venture capital funding is for high growth tech or tech enabled startups that can scale exponentially without having to necessarily get to positive unit economics, because growth from a top line perspective, customers, transaction volume, revenue, is so much more important than just creating something that is profitable or sustainable. Eventually, if you look at some of the biggest tech startups in the world, from the Teslas to the Amazons to the Googles to the Metas to even the more recent ones in the last decade, like the Ubers, the Airbnbs, etc., they've all raised venture funding because venture funding funds businesses at scale. It teaches you how to grow from 0 to 1, not from 1 to n. The vast majority of businesses do not meet that requirement. Most businesses in Africa need low cost, preferably low cost debt funding, supplier finance, maybe some sort of convertible loans or things that essentially solve for working capital. Venture funding is predominantly used to build great technology and products, scale your teams, and to acquire customers at an exponentially quicker and faster rate than anything else on planet Earth. And very, very few businesses meet that requirement. So a lot of founders think, because venture has been over-glamorized, that their business is a good fit for venture, but it's not. I would say, like I said earlier, less than 0.1% actually meet that criteria. And now, VCs expect a lot from funders. VCs aren't investing in businesses to make 5-10% a year. VCs are investing in businesses. There's an old saying, VCs don't care about strikeouts, they care about home runs. So you can have lots of strikeouts, it's a baseball analogy, but home runs are what matter, right? So you can have a lot of companies that fail in your portfolio for the 5 or 10% that succeed, but the ones that succeed perform exceptionally well, that make up for all the failures.
Let's talk a little bit about what makes you say yes. So they might meet a lot of these criteria, but there are nuances involved in all of this, right? So what are some of the things that make you say yes, that might even be counterintuitive to your advice, and the things that make you walk away even if they meet a lot of the metrics that you've just mentioned?
Yeah, there are lots of factors. I mean, and I think people have mentioned this in the past, but it sounds repetitive, but the quality of the team is extremely important. The team, I would back, or we as Launch Africa would back an A team with a B product over a B team with an A product. It's as simple as that. But what we look for in founders is this very fine balance between a little bit of it's a balance between being ambitious but not too arrogant or cocky, and a balance between not being too meek or timid or shy versus being mentorable or coachable. So that fine line, which very few founders can have, is what we look for from a personality traits perspective. We obviously prefer founders that have had experience running businesses before. So in established markets for venture like the US or perhaps India or China, you have a lot of repeat entrepreneurs. Africa is now going through, at best, its second generation of entrepreneurs. So you don't have a lot of entrepreneurs that have founded 1 or 2 businesses before this. So as a proxy for entrepreneurial track record, we look for people that have significant networks in large corporates, because the biggest killer of a startup's growth is lack of distribution and lack of getting customer data and the cost of acquiring customers becomes prohibitively expensive to scale. So if you're a first-time founder, but you spend 10 years or 20 years in a telco or a bank or an insurance company, you know that if you can build a product that's innovative, you know who you're selling to. You don't have to spend hundreds of thousands of dollars acquiring customers because your networks in your corporate connections can help you do that. That's why JVs, licenses, royalty agreements, white label agreements, pilots, proof of concepts are super important. That's the other thing we look for from a founder background perspective. And then ultimately, we look at businesses that solve local problems. So they think local, but they act global. And that mindset in entrepreneurs to have, I wouldn't say global domination, but build products that have applications globally, extremely important, right? I mean, there are so many examples of European and American and Asian businesses that solved local problems, but eventually had global applications. I mean, even the most common ones like Spotify or Airbnb, etc. You know, people weren't using them all over the world, but they solved local problems, right? In Africa, financial services, fintech, financial inclusion, access to credit, things like better technology in education systems, better access to healthcare, drugs, medicines, doctors. These are local problems, but are also just as equal global problems, right? The other thing I would say is, I'm not sort of giving too many sort of secrets away, is understanding that there's only so much you can do locally without having partnerships. So I always say that as an entrepreneur, you don't want to own the entire barn, the entire shed. You want to be able to share revenue with others in exchange for scale. So I've always say if all you care about is margins, you'll become a very big fish in a small pond. Or as I often say, you'll become a whale in a puddle. Right? It doesn't make any sense. The smartest entrepreneurs strike partnerships in things they cannot do or customers they cannot reach. So they sacrifice margin for volume. And that's how you grow. And that's through, like I said, affiliate agreements, JVs, licenses, partnerships. That's how big companies become great companies.
I had to pause there for a bit because the second question, you give all this great advice, but entrepreneurs don't know what they don't know. And I think sometimes this trips them up.
Yeah.
Let's talk about prepping for a conversation with an investor.
Yeah.
Because I'm quite sure, I mean, you've got a full head of hair, unlike me. You sometimes, you want to pull it out, right?
Yeah.
But how should founders prep for investor conversations? What are the key things that would impress you when it comes to their knowledge, the questions they ask?
Yeah, I think most founders are horribly unprepared for venture investors, or any investor for that matter, because they look at VC funds or angel investors as ATMs, really. So they just pitch a product without doing any research on the investor or the investment fund. So if I were a founder, my biggest advice to you would be do a lot of research on the investors or investor funds that you're looking to raise capital from. Look at least the last 12 months of their investing track record, who they've invested and why. Most VC funds are quite transparent about their portfolio and why they've invested in them. If possible, move to 24 months so you're taking into account cyclicality and capital flows, etc. And do significant research on the businesses that they've backed and why they've backed them. Why is that important? Because if you know that a particular investor has made an investment into a company and the product that your company is building can make the other portfolio companies that the investor has backed quicker, faster, cheaper, more efficient, you're adding value not just to the investor, but to their portfolio. In investment speak, it's called improving the portfolio IRR and not just the company IRR. So very few founders have the maturity to walk into a VC's office and say, hey, this is my product. This is why I think you love it and how you can make money. But the really great founders think, well, I see that you've invested in A, B, C, D, and E in these 5 geographies. I think we could help them with these problems in addition to being a good return for you. And talking with that level of maturity and understanding just shows to a VC that you've done enough homework and diligence on them and their portfolio, and you can think like them. So the simple advice I'd give is, if you're pitching to an investor, think like an investor. If you're pitching to a corporate, think like a corporate. You have to keep taking off your hat and putting on different hats. Otherwise, you'll never be able to get what you want. And ultimately, every relationship has to be a synergistic one. It can't just be a one-sided relationship. And I think way too many founders are looking for money without offering enough of what they can give in exchange for that.
Okay, in wrapping up, the most exciting verticals or technologies on the African continent that you're keeping your eye on at the moment. Yeah, let's just talk about that first and foremost.
Yeah, absolutely. I mean, there are lots of verticals. Obviously, fintech, financial services, insurance dominates all conversations because Africa has a severe problem with financial inclusion and the unbanked and the underbanked and the underserved. I would take a little different stance there and say that because Africa has 700 to 800 million youth out of its 1.5 billion population, the average age is so small. A lot of these, a lot of the youth in Africa have to find alternative ways of being educated. And traditional education, brick and mortar schools, courses, tertiary education, higher education just does not work. It is impossible to scale. You cannot build enough physical schools to educate 800 million people, growing to more than 1 billion in just the next 20 years. Therefore, things like online education, distance learning, automation, robotics, coding, no code, learner management software systems into school, continuing education. So investing in edtech, but through CapEx light and software heavy businesses, huge opportunity. Why? Because the addressable market is so big.
Yeah. In closing, I still see VCs, early stage, pre-seed, Series A VCs getting a lot of foreign capital when it comes to their limited partners, or LPs, as the acronym normally goes, right? What do you have to say to local investors in Africa, in South Africa, which is obviously part of the continent, but this is where we're doing the interview right now and where your headquarters is based? What advice do you have to them, the ones that are sitting there holding on to their cash going, oh, I'm not quite sure if I should let go right now?
Yeah, this is a big problem that we have, and I've been talking about this for many, many, many years. I've lived in South Africa for 15 years. The reality is the attitude towards risk in South Africa and most African countries is capital preservation, not capital creation, which is why it takes decades for traditional African family offices to get to wealth, the high net worth individuals status. It's typically people in their 60s and 70s that have built wealth over 60 to 70 years and generations. It's because the attitude to risk is around, how do I protect my capital? If you look at more mature economies like the US, recently India, markets like Western Europe, etc., people understand that a certain portion of your assets have to go into private capital, which is mostly venture and private equity. So it's that risk return tolerance that people really need to get right. What you're seeing is, because there is a track record of successful exits and startup returns in markets like Nigeria, for example, Africa has had 14 unicorns, billion-dollar companies in just the last 5 years. So a growing segment of the population understand that you can get exponential returns from a venture capital asset class or direct startup investing asset class. And if it's not part of your portfolio, you're really missing a trick. Most of our investors in Fund 1 and Fund 2, which we're currently raising, are unfortunately, or fortunately, whichever way you look at it, from Europe, North America, and the Middle East. And these are family offices, individuals, and fund of funds that understand the African addressable market opportunity. And Africa is about 12 years behind the Indian tech ecosystem and about 7 to 8 years behind Latin America and Southeast Asia. I personally, as an angel investor, have made several investments where I've made more than 10 to 20 times return on our money. And no real estate portfolio or stock portfolio or bond portfolio can ever get even close to those returns. Now, obviously, there is a risk adjustment to that return. So you have to weight the failures against the successes. But most pension funds, asset managers, mutual funds in the US have a significant portion, often double-digit percentage holdings in venture and private equity. So it's a question of when people realize this. I don't think it's an if, it's going to happen. But we're all positively optimistic about it.
Zach George, co-founder of Launch Africa VC, thank you very much for your time. And I think the one thing I have to say to you as a founder is do your research before you speak to anybody. It doesn't have to only be a VC. Anybody you speak to, people you're wanting to partner with, find out what they're doing, right? Research is always going to be your best friend. And if you are a person sitting with money, a lot of big people and a lot of the LPs that you currently have in Launch Africa VC are betting on the African continent. Why aren't you? Well, that was your edition of Innovate Africa, and I'll see you next week.